Good morning, ladies and gentlemen, and welcome to the show. Today is Tuesday, the 23rd of February, 2021. Glad to have you guys here. Now, my show last night I did was pretty raw, I don't sugarcoat it for you guys. We're going into a depression, but it's not like the depression of the 1930s. This is a hyperinflationary depression, which is the exact opposite because that was a deflationary depression. But the way it's going to look to you guys on that end, it doesn't really matter so much. A depression's going to look like a depression. And the same things are going to happen that happened during the 1930s style depression. So you're asking, when is this depression going to start? I believe it's really going to be underway in 2022 and 2023. But I don't think it's going to be a real long-lasting depression like the 1930s. It's not going to last as long. And there's a reason for this. The reason is this is going to be more severe of a depression. And toward the end of this depression that's coming, it's going to require like something done to the financial system similar to what happened in Bretton Woods. They're going to have meetings and stuff, and they're going to have to rearrange the financial system. And it's going to require a building of a new financial system on top of the old financial system to end the depression. And it's probably going to be a couple years from now before that happens, because they're going to have to go through a hyperinflation first. The world is going to go through a hyperinflation first before they're able to restructure. You see, it's just inherent in the way government works. They're not reactive. What they do is they react after a situation evolves to a point where they have to react. And this situation is going to evolve over the next couple years to the point where they have to respond to it. They're going to respond to it when the currency becomes to a point of valuelessness. In other words, it doesn't buy much, You probably, quite literally, by the time they respond to it, they're going to use the currency all the way through this crisis. Even though there's hyperinflation going on, they're going to continue to use it, and the government's going to continue to keep printing and printing and printing until it gets to the point where they have to do something. And then you're going to have your Bretton Woods moment. You're going to have some sort of new monetary system formed. And they're probably going to have to go back to gold and silver. Or it might be cryptos. But we'll have to wait and see when that moment arrives, But anyway, the system is shuddering and shaking this morning because the bond market is going too high on the long end of the yield curve, especially the 10-year. And what's happening is it's going to start to rip the system apart. They have to do something about it. But the problem is, if they do something about it, direct yield curve control on the long end of the yield curve, the Fed can do that. And they're going to have to. In my opinion, they're going to have to do that. If they do that, then it's going to be a direct signal to the entire world that inflation's the way it's going to go. It's gonna be inflation, and they're gonna control along. And see, normally under inflationary conditions like this, that's what happens. The long end starts to go up. We start to see inflation. The long end of the yield curve starts to go up, and there's no end to how high it can go, and that'll break the system now at this point. They can't let that happen. And so that direct yield curve control is a signal to everybody out there. And when they do that, before they do it, we're going to suffer through some things like we're seeing now. Prices dropping, like on cryptocurrencies, gold, silver, prices dropping. Prices dropping on oil this morning. Prices dropping on the Dow. Prices dropping. This is deflation. System's starting to try to deflate. They can't. They got to keep it propped up. And that means yield curve control now. And so just wait for it. It's like right now, it's kind of like the thing. When you're looking at the silver and gold markets, I know you guys, a lot of you guys that listen to me are interested in silver and gold, and you're interested in cryptocurrencies. Guys, Wait for it. 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 Yield curve control's coming, and when it hits, you're going to see a turnaround, a huge turnaround in the price of these asset classes. We got $1.9 trillion that they're going to try to push through the House this week coming. You know, you got to wait for it, guys. I mean, right now we're in this thing, you know. Anyway, let's get started and let's open up the charts right here and take a look at what's going on. Silver price today down 79 cents, and see it really falling like a stone. You see it? That's what's happening right now, is with this long end of the yield curve starting to rise on the treasuries. That's a direct effect now. We're starting to see direct effects from these creeping up of these treasury yields. This is all directly connected to the treasury yields. So is the MOVE index today, when we see the MOVE index rising, when we get further into the show. The system's cracking apart right now. The system's cracking apart. And they're going to have to step in. They will have to step in. I have very much confidence that they will step in to try to save the system at a certain point. But we could see a fall off in a lot of these asset classes, 25% or more, before they step in. But here we're seeing it. Don't let it shake you too much. Don't let it shake you out of the tree. Don't panic and try to sell your stuff, you know, or whatever. It's that thing. Wait for it. Wait for it. Here it comes, you know. So we're seeing the silver price fall 88 cents so far. Let's take a look at cryptocurrencies today. We're looking at 1453. Let me refresh the page. 1427. Yeah, they're falling like a stone too right now. 61.9% Bitcoin dominance and the Bitcoin price of 46,162. Looks like it's falling $1,000 to a time. All the coins are falling. They're all into the red today. Big time. And it's continuing. And this is, the bubbles are starting to pop. The bond market right now is starting to pop the bubbles. And yeah, if they don't come in and check it, it'll pop everything. The further they let this go to, you know, these guys are academics. This means basically most of these politicians and stuff are really a whole bunch of lawyers, is what they are, you know. Lawyer. They're lawyers is basically what they are at the root of it, you know. And they don't really understand these markets and how things actually work in the real world, in the financial system. How one cog, it's like a big machine. One cog turns the next cog, which turns the next cog, which turns the next cog. So if you get a cog with some teeth missing on it, and it's broken cog, the whole machine's going to break down. And that's what's happening right now with the bond market. The machine's breaking down. It's breaking down everything in the machine. Now, if they let it go, if they let the machine run that way, it'll strip all the cogs, and the whole machine will just, smoke will come out of the machine, and a big bang clunk, and a piston will come sliding out of the side of the machine. How long do they want to let this go? Because the repairs are going to be more and more extensive the longer they let this go. The market's just turned. Everything's just turned right now. And the deeper they let it cut, the more money it's going to take to pull it back. And they can't let it go all the way it wants to go, because if they just let it go and stand back and say, okay, we're not going to do nothing, we're just going to sit back and watch this financial machine blow itself to pieces. Believe me, it will go super critical in the end. And the whole thing will freeze. And, I mean, it's just, at that point, it's, you know, the whole thing just melts in front of their eyes, almost like a cherry sundae out on a hot 90-degree Texas day. You know, I mean, this is where we're at with this thing, and they got to step in and do something, or everything's on the line. The whole world, at a certain point, they will panic. Even though they're academics and everything, at a certain point, they'll say, hey, we got to do something. And they'll overreact. That's what they always do. They always overreact, you know. And the only thing they can do is dump money at it. And how much will it take? I mean, it depends on how many days they let it go down, how many days they let it break apart. Each day, maybe $1 trillion more it'll take to bring it back. You know, but let them print. Let them print. 1427 for cryptocurrencies, and we see it falling off. This is a direct result of the bond market. Dow Jones Industrial Average, 247 points down right now. Well, let me refresh the page. 237. The Dow's not reacting as much as the other markets, like the Nasdaq, and they reacted a little bit quicker than the Dow, and they reacted a little bit more violently to this than the Dow, but the Dow might be coming. We have to wait. The Dow might really fall off big very, very soon, you know. Crude oil, 61.36. It's down 34 cents. Now, see, crude oil's starting to fall off. Everything's starting to fall off today. Today's the first day. Things are starting to crack apart. They're going to have to get on top of it. You know, you might not even hear about it. All of a sudden, all these markets might start to turn around in a day or two. And it's because they're doing something behind the scenes to solve this problem. But everything they do is money. Money. They throw money at it. You know, you cannot throw money at a hyperinflation. You cannot throw money at inflation. It does not stop it. It doesn't work. Move index today, 62.42. Now, I saw this ahead of time in the move index. I saw it start to go up. I'll tell you what day it was. Looks like it was just 1, 2, 3, 4, 5 days ago. It started to shoot up. For 5 days, it's been shooting up. Move index. And it shot up. It was down in the 40s. 45.95 just 6 days ago. And this is your indicator right here, big indicator. There's a problem. You know, it's similar to the problem they were having before with the repo market. You know, let's go back and I'll show you how the move index shot up during the repo market crisis. I think I'm going to have to go back 5 years. See this big mountain right here? Right here, this big mountain. That's where this market, the move index, shot up during when they did the repo crisis back in that period. Was during that big mountain, and then it fell out back off again. Now look, she's starting to rise back up again. We got a problem again. Had a little problem here in the interim, and they fixed it. They could fix this one. We'll have to wait and see. But they're going to have to keep these this long end down on the yield curve. You look at the 10-year, it's over 1.36. It should not be going over 1.35, you know. And once it hits 1.4, then they really got a huge problem. They got to control that 10-year. It's a very delicate balance with the 10-year right now. And that balance is 1.4. You don't want to go over 1.4. Or you start to get up toward 1.5, you got a big problem. And see, this is the thing. It's like balancing that 8-ball on top of the glass table. It's a very delicate balance. That's what the system's become. You know, you go back 20 years ago, back when Paul Volcker was able to raise interest rates and stuff. It was like balancing that 8-ball on rough ground. You could shake the ground and it's still not going to move because there's potholes and everything that, you know, or on soft soil. Say you had your 8-ball on top of powdered clay, you know, and the 8-ball's in a little dent in the clay. You can move the clay around. That ball ain't going to move because it's not a smooth surface that the ball's on. What's happened is the financial system has become that glass surface now. And the ball moves very easily at the slightest. So Paul Volcker, if he's alive today, he couldn't raise interest rates up to 20%. The system can't stand it. Now everything has to be kept very, very delicate balance in the whole thing, you know. And it's starting to fall apart on them. So now they got to do something. And their only answer is money. Dump more money on it, boys. Dump more money on it. At a certain point, I mean, already, I think the world's getting back, standing back and saying, hey, you know, this is going to inflate. Big time, you know. But that's going to get an awful lot worse. Dollar index today, 90.25 on the U.S. dollar index. And the dollar looks like it's going up, and this is deflationary signals all through the system right now. She's starting to deflate. But, you know, they got a bazooka, a money bazooka. And they're going to get in there, and they're going to do what they have to do. They're academics, and they will just go ahead and they will pump that money to it no matter where it takes. If they see a hole in the system and they see something starting to crack, they'll just go in there and dump money. Because it's the only thing they know how to do. It's the only tool that they have. And when your only tool is a hammer, everything looks like a nail. You know? And so that's the thing. Anyway, listen, guys. Last night I did that show, and I was talking about how the system's going to look in a year or two from down the road from now. You know, it's going to be poverty, and you know these groups of people that'll have to live in their cars. What they'll end up doing is they'll end up forming together like caravans and stuff. You know, where they'll watch out for one another, because a lot of them are good people. A lot of the people that are going to have to live in their cars are going to be good people, and there's going to be a lot of people that don't even have a car. And, you know, people are going to form together, and they're going to try to help one another. They did that during the Great Depression, you know, in the Great Depression era. And it's just going to be so many of them everywhere. It's going to be pitiful, you know. Basically, what's happening is we're going through the Great Depression all over again. Except this one has more energy. This one's a bit bigger. It's a bit stronger than the Great Depression. It's probably 40%, 30, 40, 50% more energy to it as far as what's causing it. The effect, the net effect of it's going to be greater, you know. So there's going to be more poverty than the Great Depression. And more people out of work, and more people living from their cars, and it's just going to... It depends on what area you're in. Area is going to be very important in this. I'm going to tell you guys what. There's going to be certain areas that almost completely escape and avoid all of this. And it's almost going to look like business as usual in certain areas. Really depends on what area you're in. If you're in some areas, it's going to be terrible. You know, and it was the same way during the Great Depression. Not everybody suffered during the Great Depression. It's going to be the same way with this. A lot of it's going to depend on what area you're in. Your area might not be affected very much. It's the same, worked the same way with the coronavirus. You notice how some areas went through an awful lot of trouble with the coronavirus, like New York, you know, where other areas, it wasn't much of a big deal, you know. I mean, it just depends on what area you're in. That means an awful lot where you're at. And who was it wrote a book called Strategic Relocation or something? I remember some sort of book. But that is important. You know, in real estate, it's very important too. They always say area, 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 or location, location, location. Means everything in real estate. Thank you guys for listening. Like and subscribe, and we'll catch you guys in the very next episode. Bye-bye.